previous slides talk about generally accepted accounting principles, otherwise known as GAAP. Financial accounting is governed by concepts and rules known as generally accepted accounting principles. The three important rules are that information should be relevant, reliable, and comparable. Relevant information is that information that would affect the decisions of users. So if it's something minor, something like the CEO of a company bought a wastebasket, that's not relevant. That wouldn't matter really to anyone deciding if they should invest in the company or not. Reliable information is trusted by users. It should be information that you know came from someplace that you can trust, that the person or source of the information won't gain anything or lose anything by sharing that information. And comparable information allows you to contrast organizations, so you can look at two totally different companies and still make a decision about them and contrast them. The principles and assumptions of accounting fall into two categories. General principles are basic assumptions, concepts, and guidelines. These stem from long-used accounting practices. And specific principles are the detailed rules used in reporting business transactions and events. These usually come from a question that someone needs answered, and the authoritative groups will rule on that question. The principles are shown here, and the assumptions are here. And we'll look at a couple of them. Measurement principle or cost principle is one of the first accounting principles, which means that accounting information is based on actual cost. If you pay $150,000 for a building today, that's what you record it as. It doesn't matter if that value changes over time. You do not change the value on your books. You keep it at the cost that you actually paid for it. Revenue recognition is another really important one. Revenue is defined as what the company makes for doing the work that it does. We recognize revenue when it is earned, not necessarily when you get paid for doing something, but when you earn that money is when you recognize it or record it as revenue. Proceeds don't have to be in cash. Sometimes you might get paid in something else. I pay Max in cookies. It works for us. And revenue is measured by the cash received plus the cash value of the items received. So if I were to put a value on those cookies, I would say 50 cents a cookie. I pay him about $1 a day. That's the cash value of those items. Expense recognition principle used to be called matching principle. We get into this more in Chapter 3. A company should record the expenses incurred to generate the revenue reported. And like I said, we'll get into that much more in Chapter 3. And full disclosure principle, a company is required to report the details behind the financial statements that would impact users' decisions. So they have to tell you anything, how they came to the numbers that are recorded there. And we'll also see this more in further chapters as well. Assumptions are a little bit looser. Going concern assumption, this just means that we expect the company to continue operating. If it were going to be sold or closed, the accounting is a little bit different. So we're assuming that it's going to keep on going. Monetary unit, we express transactions and events in monetary units, not in cookies. And the business entity assumption, we assume that the business is accounted for separately from other business entities, including its owner. So you don't take the company credit card and go out and buy cookies for the dog. You go and buy things for the business only, and cookies for the dog come out of your own credit card. And time period assumption presumes that the life of a company can be divided into time periods such as months and years. This also becomes important in Chapter 3. We talk more about that. And that's the end of this little presentation.